Welcome to my channel, Management Accounting Made Easy. This is Standard Costing and Variance Analysis Part 4. In this Part 4 of Variance Analysis, we are going to cover fixed overhead variances. Under fixed overhead variances, we are going to see fixed overhead expenditure variance, fixed overhead volume variance, fixed overhead capacity variance, and fixed overhead efficiency variance. Here we are going to see the fixed overhead variances under marginal costing. We know whichever costing we use, fixed overheads do not flex with the level of activity. So now we'll see. Under marginal costing, we treat the fixed cost as a period cost. So the full fixed cost will be written off to the profit and loss account. So under marginal costing, there is no under or over absorption of overhead. So the only fixed overhead variances we will come across is the fixed overhead expenditure variance. So under marginal costing, the fixed overhead cost variance is equal to the fixed overhead expenditure variance because fixed overhead is treated as a period cost. So under marginal costing, there is only one fixed overhead variance, which is the fixed overhead expenditure variance. Here we are going to see fixed overhead variances under absorption costing. Under absorption costing, fixed overhead is absorbed using predetermined overhead absorption rates. Predetermined overhead absorption rates are the budgeted absorption rates. So the actual results will be different from the budgeted or the predetermined rates. So under absorption costing, we will have either under absorbed fixed overhead or over absorbed fixed overhead. Under absorbed fixed overhead means we have undercharged the fixed overhead cost to the profit and loss account. On the other hand, over absorbed fixed overhead means we have overcharged the fixed overhead to the profit and loss account. So we are going to see a simple example for under absorption and over absorption of fixed overheads. So here the company has produced 5,000 units. Predetermined overhead absorption rate is $7 per unit. So this predetermined overhead absorption rate is the budgeted overhead absorption rate. So the overhead absorbed is 5,000 units times $7 per unit, $35,000. But the actual overhead incurred is $30,000. So if I simplify this, actual overhead incurred is, if we get the invoice from our supplier, the invoice says $30,000. So this shows we have overcharged $5,000 to our profit and loss account. So this is called an over absorption of overhead. So how do we make the adjustment? We have to credit the profit and loss account to make the adjustment so that our profit will be increased. So on the other hand, we are going to see the under absorption of overhead. So we are going to use the same example. So the example says the overhead absorbed is $35,000, but the actual overhead incurred is $40,000. As I mentioned before, when we get the invoice from our supplier, it says $40,000. So this means we have undercharged the $5,000 to our profit and loss account. So this is called under absorption of fixed overhead. So this will be debited to the profit and loss account in order to reduce the profit. So we'll see another simple example here. Safari Limited absorbs overhead using machine hours. Overhead absorption rate is $4.25 per machine hour. So this is our budgeted overhead absorption rate. For the month of March, budgeted machine hours was 25,000 hours. Actual results for the month of March was 22,000 machine hours. Overhead incurred 100,000 and $500. So we need to calculate whether there is an under or over absorption of overhead. So we'll see the overhead absorbed. So they worked for 22,000 machine hours. Each machine hour they would have absorbed $4.25. So altogether the overhead absorbed is $93,500. But the actual overhead incurred is $100,500. So basically, the actual overhead incurred is more than what we have absorbed. So this is called under absorption of overhead, which is $7,000. So this under absorbed overhead will be debited to the profit and loss account. We have seen under marginal costing, the only fixed overhead variance is the fixed overhead expenditure variance. But under absorption costing, the fixed overhead cost variance is subdivided into fixed overhead expenditure variance and fixed overhead volume variance. Fixed overhead volume variance is further subdivided into fixed overhead capacity variance and fixed overhead efficiency variance. Fixed overhead expenditure variance, explanation and calculation. Fixed overhead expenditure variance is one of the very easy variances to calculate. As we know, fixed overhead do not flex with the level of activity. So, to calculate the fixed overhead expenditure variance, we simply compare the budgeted fixed overhead expenditure with the actual fixed overhead expenditure. So, how to calculate the fixed overhead expenditure variance? You take the budgeted fixed overhead cost, take away the actual fixed overhead cost, and we get the variance. If the actual fixed overhead expenditure is less than the budgeted fixed overhead expenditure, then there will be a favorable fixed overhead expenditure variance. For example, if the budgeted fixed overhead expenditure is $10,000 and the actual fixed overhead expenditure is $8,000, then the difference of $2,000 is a favorable fixed overhead expenditure variance. On the other hand, if the actual fixed overhead expenditure is greater than the budgeted fixed overhead expenditure, then there will be an adverse fixed overhead expenditure variance. For example, if the budgeted fixed overhead expenditure is $10,000 and the actual fixed overhead expenditure is $12,000, then the difference of $2,000 is an adverse fixed overhead expenditure variance. We are going to see the causes for the adverse fixed overhead expenditure variance. For example, if the factory space reaches its maximum capacity and if another space is needed to meet the demand, then the actual fixed overhead expenditure will be significantly higher than the budgeted fixed overhead expenditure. Because, say, if we have a factory space which we can produce only 10,000 units, and if we get a demand for 15,000 units, obviously we need to hire another factory space. So the fixed overhead expenditure variance will be significantly higher in this situation. Or seasonal demands. Seasonal demands may cause adverse fixed overhead expenditure variance. But these seasonal demands will be smoothed out with the off-peak demands in an year. So the causes for favorable fixed overhead expenditure variance, say in an off-peak season, your actual fixed overhead expenditure will be lower than the budgeted fixed overhead expenditure. So you will end up with a favorable fixed overhead expenditure variance. Fixed overhead volume variance. Volume variance stands for the number of units. So here we compare the budgeted number of units with the actual number of units. The difference will be multiplied by the fixed overhead absorption rate per unit. We can see by calculating the volume variance whether there is an efficient use of fixed resources or production facilities. For example, whether we have fully utilized the factory space or the depreciation of assets, insurance, or utility bills. Now, if the actual production is greater than the budgeted production, then this will show that there is an efficient use of fixed resources and we will have a favorable fixed overhead volume variance. On the other hand, if the actual production is less than the budgeted production, this will show that there is an inefficient use of fixed resources or idle fixed resources. So we will end up with an adverse fixed overhead volume variance. Fixed overhead capacity variance. This variance will help us to identify whether we have overutilized or underutilized our fixed resources. So fixed capacity utilization variance identifies whether the planned working hours or budgeted working hours is more or less than the actual working hours. This variance is calculated by comparing the budgeted working hours with the actual working hours, and the difference we times it by fixed overhead absorption rate per hour. Say we have hired a factory space for 1,000 hours, but we use that factory only for 950 hours. Then there will be an adverse fixed overhead capacity variance. We'll see why. We have underutilized the factory space. We have to pay the rent for that 1,000 hours no matter you use it or we don't use it at all. But we have only used for 950 hours. Therefore, we have underutilized the factory space time by 50 hours. Even then, we have to pay the rent for the whole 1,000 hours. So we are losing out 50 hours worth of rent. And also, we have underabsorbed the fixed overhead here. This may be caused by the production stoppages due to the labor shortages or labor strike, a breakdown of machinery, or shortage of materials, etc. Now, we'll see the other side of the capacity variance. If the budgeted working hours say 1,000 hours, but we have utilized say 1,100 hours, then there will be a favorable capacity variance. Why? Because we have used the factory space for an extra 100 hours and then we didn't pay any extra rent for that. So that's why the fixed overhead capacity variance is favorable here. fixed overhead efficiency variance. We'll see how to calculate this variance. Like the labor efficiency variance, we compare the time allowed and the time taken, and the difference, we multiply that one by the fixed overhead absorption rate per hour. If the variance is favorable, say for example, the time allowed is 40 hours, but the employees have taken only 35 hours. So that means the variance is favorable. So the workforce is highly efficient and able to produce more units and more overhead is absorbed. On the other hand, if the variance is an adverse variance, say the time allowed 40 hours, but the employees have taken 45 hours. So that means the workforce is not efficient and they were not in a position to produce more units and they have absorbed only less overheads. We are going to use an example, the Gardner Green Limited, to calculate all the fixed overhead variances. So we'll see the question. Gardner Green Limited manufactures garden furniture and uses absorption costing system. So when we see this absorption costing system, we should know we have to calculate expenditure variance and volume variance. And then the volume variance is subdivided into fixed overhead efficiency variance and fixed overhead capacity variance. We'll continue with the question. Budgeted and actual data recorded for the last quarter is as follows. So they have given the fixed production overhead budgeted and the actual figure, production budgeted and the actual figures, so as the labor hours, the budgeted labor hours and the actual labor hours. Now we need to calculate all these fixed overhead variances. So we'll start with calculating fixed overhead cost variance for the Gardner Green Limited. So we'll extract the information from the question. So the fixed production overhead budgeted is 1,098,750, but the actual fixed production overhead is 1,151,425. So we look at the production. Production, budgeted production 73,250 units, whereas the actual is 82,700 units. And also they have given the budgeted and the actual labor hours. So we'll calculate the fixed overhead cost variance. So the budgeted fixed overhead cost is, they have produced 82,700 units. So 82,700 units times it by the fixed production overhead cost per unit. That's the budgeted fixed production overhead cost per unit. So that is 1,098,750 divided by the budgeted production, which is 73,250. So we will get the budgeted fixed production overhead cost per unit is $15. So the budgeted cost is 82,700 times the $15, which is the budgeted fixed overhead cost per unit. So we will get 1,240,500. Now the actual cost is given in the question, which is 1,151,425. So the fixed overhead cost variance is $89,075 favorable, because we can see the budgeted cost is more than the actual cost. So that's why we have a favorable fixed overhead cost variance of $89,075. We are going to calculate the fixed overhead expenditure variance for Gardner Green Limited. As I mentioned before, this is one of the very easy variances to calculate. So we are going to take the fixed production overhead budgeted figure from the question and the fixed production overhead actual figure from the question. So the budgeted expenditure according to the question is 1,098,750. But the actual expenditure is 1,151,425. So the fixed overhead expenditure variance is $52,675 adverse. So we simply take away the budgeted fixed production overhead from the actual fixed production overhead and we will get the expenditure variance. So here we are going to calculate the fixed overhead volume variance for our example, the Gardner Green Limited. So the fixed overhead volume variance, we know we have to compare the budgeted number of units with the actual number of units. Then the difference, we need to times that by budgeted fixed production overhead cost per unit. So we'll see the budgeted production is 73,250 units. The actual production is 82,700 units. So we'll start calculating the fixed overhead volume variance. Budgeted volume is 73,250. Actual volume 82,700. So we have produced more units. So it's a favorable 9,450 units. As we know, we need to convert this into money value. So we need to times this by budgeted fixed production overhead cost per unit, which is 1,098,750. That's the budgeted fixed production overhead divided by the 73,250 units. So our fixed production overhead cost per unit is $15. So our fixed production volume variance is 9,450 times the $15. So we get $141,750 favorable. Now, we are going to cross-check our workings because our fixed overhead expenditure variance and the volume variance totals must add up to our fixed overhead cost variance. So if you look at the volume variance is $141,750 favorable. And our expenditure variance is $52,675 adverse. So when we add these two together, we get $89,075 favorable fixed overhead cost variance. So our workings are perfect. We have seen fixed overhead volume variance is subdivided into fixed overhead capacity variance and fixed overhead efficiency variance. So we are going to calculate the fixed overhead capacity variance for Gardner Green Limited. So we'll see the question. Fixed overhead production overhead given, budgeted and the actual, and the budgeted labor hours and the actual labor hours also given. So we know the capacity variance. We have to compare the budgeted working hours with the actual working hours. So here the budgeted working hours is 549,375 hours. The actual working hours is 560,000 hours. So we have utilized more time. So the 10,625 hours is favorable. Now we are going to times this by the fixed overhead rate per hour. as we know, the management is interested in money value. So we always convert these hours into money value using the budgeted rate. So the budgeted overhead rate is 1,098,750. This is our budgeted fixed production overhead divided by the budgeted labor hours, which is 549,375. So we get fixed overhead rate per hour is $2. So the capacity variance is $21,250 favorable. We are going to calculate the fixed overhead efficiency variance for the Gardner Green Limited. So we'll see the question: fixed production overhead budgeted and the actual data given, production budgeted units and the actual units given, so as the labor hours, budgeted labor hours and the actual labor hours given. We are going to calculate the efficiency variance. So the time allowed is 82,700 units they have actually produced. Each unit they should have taken 7.5 hours. We'll see how to calculate the 7.5 hours. Budgeted labor hours is 549,375 divided by the budgeted production, which is 73,250. So we get 7.5 hours per unit. So the time allowed is 7.5 hours per unit times 82,700 units. We get 620,250 hours. But the time taken is 560,000 hours. So we have saved 60,250 hours. So it's a favorable variance. Now we need to convert that into money value. So fixed overhead rate per hour is budgeted fixed overhead is 1,098,750 divided by the budgeted labor hours, which is 549,375 hours. So the fixed overhead rate per hour is $2. So our fixed overhead efficiency variance is $120,000, 500 favorable. Now we can cross-check our calculation because the volume variance is subdivided into efficiency and capacity variance. So our efficiency variance is 120,500 favorable plus our capacity variance $21,250 favorable. So the volume variance is $141,750 favorable. So from this we know our calculations are correct. Thank you for watching. If you like this video, please like, share and subscribe. I'll see you in part 5 of standard costing and variance analysis.